Good afternoon, everybody. My name is Lynn Drake with Compass Commercial, and this afternoon I have the honor of interviewing Cass Bagchi, and she is with the Honigman Law Firm. How are you today?
I'm great, Lynn. It's good to see you,
Good to
even via Zoom.
Via Zoom. That's all we do today is Zoom.
Yeah.
Isn't it? We're going to be talking about lending from a legal perspective, which I think is super important if you are purchasing properties, because people don't always think about these details, which is what Cass specializes in, right?
I do.
So just to give you a little bit about Cass's background, she is a partner at Honigman. She counsels and manages risks for clients in loan, real estate, and other asset-based transactions by concentrating on acquisitions and lending from a purchaser-borrower perspective and a lender perspective. She quickly navigates through transactions, spots issues, resolves issues to close the transaction in a timely and efficient manner. She has authored articles published in the Michigan Law Weekly, Commercial Investment Real Estate, and Medical Law Reports. She has served as the events committee chair for TIE Detroit for several years, and I never even heard of that until I looked it up. It's for self-employed people, right? It's a pretty big organization.
Yes. It's an entrepreneur group that I was on the board of.
Yeah, so that was news to me. Being an entrepreneur, I should have known. She has also served on the board of Indo-America Chamber of Commerce, and as part of the board, she has launched Meet the Market to encourage connections among centers of influence and members of the chamber. Cass is now eager to learn how to network in this post-COVID era.
It's different.
And I'm glad you brought that up because I think it's important that what we're talking about today, we are in September of 2020, and particularly in the law field, things are really subject to change. So it's kind of important to know what date we're talking about here.
Mm-hmm.
Cass has received a Bachelor's of Arts in Political Science with honors from UCLA, and subsequently was awarded her Juris Doctorate degree with honors from Tulane University School of Law. She was admitted to the bars of New Jersey, Pennsylvania, which I guess is currently inactive, mm-hmm. California, and Michigan.
Yeah.
That's a lot of accomplishments.
Oh, well, it's a lot of bar exams. That's what
a lot of bar exams.
Good bar exam taker.
All right, so let's just jump in here. We got
Sure.
a bunch of questions we're going to go through.
Yep.
So Cass, at a high level, can you share what are critical questions a business owner should be asking if they're looking for financing?
Absolutely. So when you're an owner and an operator of business, you are wearing so many different hats every day, having to make decisions nonstop. Today, I want to spend some time with you and your fans to focus on what kind of questions should they be asking when they are looking at a possibility of financing their business and their real estate, more importantly, to mm-hmm. maybe pull out money for their business to help them make their decision. There's lots of questions, but the point of this exercise is really to help them know what those questions are. So when they go meet with prospective lenders, they're kind of armed. It's kind of like the buyer beware situation, right? So even in today's climate where lending is, it's tightened up. There's no question about it. It's probably not as fluid as it was even 4 months ago. Mm-hmm. There's still differences between loan products. One size does not fit all. Mm-hmm. And it's important to kind of understand how your business, your company fits in with the loan product and what impacts it's going to have on your company and its operations and ultimately your bottom line cash flow. So, that's the purpose of our topic today. And, if you're okay with it, I'm just going to launch in with the first set of questions, I guess.
Sure.
Which is what the first question is, that's like a big bucket question. It's a loaded question is, what are the obligations and how do they impact my operations as a business owner. So the categories under loan obligations that you should be looking at are economic terms. There's also a question of the type of collateral they're looking for. And the third bucket would probably be operational covenants. So diving into the details of that a little bit more, when I'm talking about economic terms, I'm talking about the things that most people are aware of, which is asking about how much money can I get for my loan? What am I looking for? What am I asking for? What can the lender actually agree to give? The second question is the loan term itself. The shorter the loan term you have, the quicker you have to repay it. The longer the loan term you have, obviously you have more time to pay it. So all of these kind of impact your cash flow, obviously. The shorter the loan term means you have to come up with a quicker plan to exit it and repay. And the longer the loan term means you have longer to just kind of ride it out and see how you can exit out later on. The one thing you do want to kind of avoid when you're looking at loan terms, if you can, is a concept known as a demand note, where a lender agrees to make you a loan, but they can call it at any time. You see this a lot in lines of credits.
Yeah, that's what I was thinking. Yeah.
More than anything else. Even lines of credit that are secured by real estate. It's not very common in what I see on the commercial side, but it's still out there. And so business owners should kind of be wary of any lender who says, hey, I've got a great interest rate price for you, but I'm not telling you now, but it's going to be a demand note. I mean, it just creates a certain level of uncertainty, I think, if you're a business owner trying to plan when it's a demand note. The kind of like the third component to the economic obligations part is interest rates. Now, I could probably spend 5 hours talking about interest rates, but I'm going to lose everybody. I'm going to lose myself. Here's the big concept questions to talk about when you're asking about interest rates is it fixed? Is it a floating rate? Is there a floor? And what I mean by is there a floor, that means is there a minimum amount of interest that the lender is going to be charging no matter what the floating rate might be under prime or what the fixed rate might be. The other layer to interest rates, which again could lead to weeks of boring conversation, is whether or not the lender requires what's known as hedging contracts and swap products, which help the lender and the borrower sort of fix a floating rate. It's a complicated topic. I'm not going to go into the details of this. Quite frankly, there are articles and articles about this, which again lead to good nighttime sleeping. It's a conversation for another day. So that's kind of interest rates in a bucket. The next kind of economic repayment term kind of question you should be asking that affects your cash flow as a business owner is amortization period. Okay, because there are interest-only loans out there if you qualify for them, but more likely than not, it'll be principal and interest. And what drives that formula of how much your monthly payments are going to be is not just the interest rate, but any amortization period that the lender is going to use. And amortization periods can be all over the board. Sometimes they're, in the typical, when you're buying a home, which is the most classic example most people are, used to seeing, it's 30 years, 30-year amortization, right? Business loans for real estate are anywhere from 25 years to 30 years. Some of them are self-level amortization, which means you won't have a balloon payment at the end. But what does that mean? It means you're making larger payments from your cash flow every month when that happens, right? So always a good question to ask, what kind of amortization period are you offering, what the interest rate you're giving me? Because again, it helps you kind of budget what your monthly outflow is going to be for your debt service payments under that loan.
Cass, what would be an example of why someone would want to use an interest-only loan? Would it be like a land purchase or?
Yeah. So interest-only loans are great for folks who are doing real property acquisitions and refinances, because guess what? They're only paying interest only every month. Every month, that's all they're doing. So they get to they're keeping all the other cash for themselves, right? So it's if they can, ultimately, when you're doing regular investment real estate kind of purchasing, you're going to be constantly refinancing these properties.
Right.
Even as a business owner who's owner occupying the property that they're doing the financing, you're going to be refinancing these properties constantly. If your goal is to try to keep the amount that you're laying out for these loan payments as small as possible, you're going to want to do interest only, so that all you're doing is writing a check for the interest only. And then assuming that your property values don't go down, you're going to easily be able to refinance and get another loan when the time comes up for it to pay it. That's kind of like the thinking there, is to keep your monthly payments down for the loan by asking for the interest only portion. And again, I do see it even in commercial lending context. I mentioned to you, I do quite a bit of Fannie and Freddie work, and even they offer for multifamily, financing interest-only products, sometimes for 1 year, sometimes for 2 years, sometimes for 10 years. It really depends on the level of the borrower you are and what you're bringing to the table in terms of your credit. Okay, and I think we just talked about this, or referenced this just a few seconds ago. There's a difference between a line of credit, right, and then and just getting a straight loan. So in a line of credit, you can get a line of credit that's secured by real property. In a line of credit situation, you're asking for repeated draws over time. So let's say you're asking for a line of credit to finance inventory for your business. You could get a line of credit that's secured by your real property, and how it would work is the line of credit would be maxed limit for about, let's say, $2 million. I'm just throwing an item out. But at the day of closing, you may only ask for like $200,000 with $1.8 million on the balance left to borrow over time. So you would pay, typically in a line of credit, you're paying interest only on the portion that you borrowed. The other kind of loan, again, is what most people are used to seeing, is you get all of the proceeds up front. So instead of where a line of credit, you're going up and down on the balance, in the $2 million loan situation, let's say you get all the proceeds up front. There is no going back and asking for more money without amending the loan itself, which has, it's additional closing costs. It's possible if there's value there, but it's two different kinds of products, line of credit versus just a straight mortgage loan. The kind of like the other component to your costs when you're shopping around for loans is not just the repayment piece of it, which, includes your interest, your principal, your amortization period, the term of the loan itself. The other kind of nugget to ask is the lender going to require any escrows in addition to the regular installment payments under the loan? And what are the typical things that lenders might ask escrows for? I think everybody's used to seeing, escrows for taxes and insurance. Even if you've never bought a commercial property, if you own a home, you've seen it in your home mortgage loan documents. Another classic kind of reserve that lenders ask for escrows is known as replacement reserves. You put in every month extra money every month to set aside for capital replacements that you ought to be doing as a commercial property owner. Another type of reserve is for repair reserves. Usually as part of doing a loan closing, the lender is going to come out and inspect your property. If they see things that need to be immediately repaired, they'll oftentimes say, well, you know what, you got to fix this, otherwise you don't get my loan. Put this money down up front now with your loan closing proceeds, or we'll deduct it from it, and then we'll take from it so you can, take the money out of the reserves to do your repairs. So it's always important to ask, what kind of reserves does this particular lender ask for from their customers? And then if they tell you, yeah, we require them, then the follow-up question is, well, is it escrows that are coming out and being deducted from the loan proceeds? Or am I coming out of pocket to fund that reserve after closing, right? So typically taxes and insurance come out of a borrower's pocket. Sometimes in the bridge, it's called bridge lending scenario or hard money lending scenario, loan proceeds will be set aside to fund taxes and insurance, but typically that comes out of borrower's pocket after the closing. The other question to kind of ask if the lender is asking for reserves is, how do I get my money out? It's great that you're collecting it, either by setting it aside for my loan proceeds or asking me to contribute to it. But what do I got to do to get the money out of there? Do I have to give you a written request? Do I have to do something else besides that? So by way of example, in taxes and insurance situation on a commercial loan, what most lenders will say is, you got to at least give us the tax bills in advance of when they're due. You got to give us the insurance bill in advance of when they're due. Otherwise, we're not on the hook for paying for them if we don't pay them. It's on you, property owner, to tell us. For repair reserves and replacement reserves, the common ask is, you don't get the dollars out until you finished it, finished the repair or the replacement, and you show to us you did it, and you've spent the money yourself to do it, then you can ask us and reimburse for it.
Right.
So that's like the typical approach that most lenders take.
Right, and I think most business owners, when they're buying a building, it's not going to be laid out appropriately for them. So they're going to need to go and hire architect or designers, make some changes, build it out. So that's important to understand that you can finance that.
Correct. And you're hinting at a type of loan in particular, where when you have an architect and let's say a GC, a general contractor involved, you're probably looking at a full-blown construction loan. And again, that's a very large topic with a lot of hurdles. So probably just kind of gloss over that and save it for another rainy day. So we touched on reserves, repayment terms. The other kind of economic obligation that you should be talking to your lender about before you kind of sign on the dotted line is, what kind of assurances are they looking for to make sure that you repay the loan? And I say the word assurance is a fancy word for collateral, right? And I mean, obviously, unsecured loans are possible. I guess credit cards are doing it every day, but in the real property context, you're posting your real property as collateral. I mean, there's no question about it. So that's why they're giving you the loan. But sometimes it could be other collateral that they're asking for too. So it's always good to ask, what are you asking for? Is it just the mortgage? Are you asking for any kind of other what's known as collateral cash accounts for me? Not that you're going to offer it, but I would just gently ask, is it just the mortgage that you're looking for? The reason I'd say you pose it that way is because the next layer of assurance that most real property lenders get are guarantees. Guarantees typically from the principal of the company that's getting the loan. They're looking usually to ask for guarantees from people who control the borrowing entity, who are the management makers and the decision makers. And there are all different kinds of guarantees that are out there. So when you're shopping for loans, you should be asking, okay, are you asking for a guarantee? Who are you going to ask it from? Are you going to ask it from me as the business owner? Are you going to ask it from the guy who owns 10% of my company? Hopefully not, because they have no decision-making power. What kind of guarantee are you asking for? Is it a full recourse guarantee where if everything and anything goes wrong, you're coming after me? Or can we limit it to what are known as the bad boy acts? Those are known as limited recourse guarantees. And Lynn, I'm just going to say this. That's also a large topic for another day, but that list of bad boy acts, it's grown. I mean, there's a lot. There's a lot of events that can now trigger some kind of recourse liability for a business owner. It used to be when somebody referred to the bad boy acts, it meant I lied, I stole, I committed fraud, I didn't use insurance proceeds, and I filed for bankruptcy. Okay, those were like the typical 20 years ago bad boy acts. We've now been through, the 2008 recession, and now whatever you want to call this now that we're going through.
Don't know what to call it.
The pandemic moment, I don't know. That list of bad boy acts is growing because lenders, they want to the lenders want to be the borrower's best friend, the business owner's best friend, but they ultimately have to protect themselves. So how do they do that? If there's not enough value in the property, they're going to try to extract it from somewhere else.
Right.
And so that list of, bad boy acts has been growing. So it includes misapplication of rents, colluding to cause bankruptcy, and the list goes on. I won't bore you with the details, but the trick here is to just kind of get a gloss from the person you're shopping your loan with to find out, what am I looking at here if I sign up as a guarantor? What is your typical approach? And what are you asking for? Okay, so we talked about economic repayment terms. We talked about collaterals and guarantees and the type of questions you should be asking there. The next set of economic obligations that has real true administrative costs to a business owner are what I'll call the operational covenants. And the reason why these have administrative costs to a business owner is they require the business owner to adopt certain standard operating procedures, otherwise they'll be in default of the loan, which the business owner may not have or may not normally do, especially if it's like a mom and pop business owner and it's a closely held company with just, one owner and, their spouse running the back, the front of the real estate store or whatever you want to call it. It's a lot of these covenants sometimes aren't normally intrinsic to a business. And so it's important to find out what these operational covenants are and how do you have to kind of modify your standard operating procedures so that you don't trip a default. So what kind of operational covenants am I talking about? So
I was just going to ask you.
Yeah. So, a big one that you see particularly in loans where the real property that you're mortgaging is income producing, meaning lots of tenants, whether it's apartment complex or shopping center or something like that, is the lender might require a cash management agreement or a lockbox agreement. Okay. So a cash management lockbox type of covenant, what does that mean? So it means that the lender is requiring you to set up two different accounts. One which is in the name of the borrower, and a second account that is in control of the lender. And the institution or the bank that hold these two accounts are required to sweep the borrower account on a daily basis and put all the funds that are in the borrower account into the second account that's controlled by the lender. The second kind of component to the cash management lockbox agreement is you as the borrower have to tell all your tenants, you have to send a notice to all your tenants saying, I've now entered into this loan, you're required to remit all your rent into this cash management account system. So what this really means is the borrower no longer really has true control on income coming in. It's going through the cash management accounts and ends up in the lender's controlled account. And the cash management agreement between the borrower and lender will dictate how those proceeds are distributed. So there will be what's known as a waterfall in the cash management system. Before an event of default happens, borrower and lender agree that, the first payments coming out of that cash management account is for, guess what? The debt service, right? And important operating expenses for the property, like taxes and insurance.
Mhm.
And if there's anything left over, then as long as there's no default, the borrower gets the balance, what we would call excess cash flow at that point,
Mhm.
right? If there is an event of default, all bets are off. No money is going to the borrower. Okay. Now, so that's that's an operational covenant that if you're, an owner of like an apartment complex or shopping center, you might want to vet out early, if they require it. Most lenders will have some concept like that spelled out in a term sheet or a commitment. They should,
Mhm.
because it's a pretty, expensive component for the borrower, because they have to now set up two separate accounts that they have to maintain and pay
Right.
fees on. Okay, not to mention the fact that they lose control over the income.
Right. Sometimes I, I have clients and they get really frustrated with me because I can't get them. They say, well, the building's been vacant for a year. And I think that even though the market is to lease this building is 20, that they should take 5.
Mhm.
So that business owner doesn't necessarily have the ability to make that decision,
Mhm.
particularly if they're behind in anything, right?
Right.
And so that, people are always like, well, why won't you make my offer? Because they can't do it, and you, a lot of times when we're negotiating, we find that, the person we're negotiating with has no decision. They're just going back to their bank
Right.
to get permission, and the bank's going to be way more conservative than that business or real estate owner, I think.
Right. Well, I'm going to hit on that.
Oh, okay.
In just a second, which is it's part of the operational covenants, leasing covenants.
Yes. Okay. Perfect. Sorry.
So it's these loan documents, particularly if you have income producing tenants in there,
Mm-hmm.
they're gonna your typical not negotiated set of loan documents that are on what are known Laser Pro documents that are like super teeny tiny print. You can have eyeglasses for. They'll say in there, you don't really have the right to enter into leases without our approval. You can't really modify leases without our approval. And you sure as heck better not be terminating any of these leases unless they
Right.
naturally expire on their own terms. So,
Right.
if you're, a business owner who owns a shopping center or an apartment complex, and you're dealing with a lender and you're shopping around, definitely make that a topic of conversation, which is, okay, my business is to do leases. I cannot come running to you every time somebody wants to sign a lease, particularly let's say in an apartment complex model. Come on. It'd be crazy,
Yeah.
right? Every time
Right,
it's moves in and out, you got to go get approval. It doesn't work that way, right?
Right.
So
Right.
for apartment complex, there should be a different set of rules.
Right.
Shopping center, there should be a different set of rules. But the trick is to ask for it, because if you do not, you're going to be spending money down the line negotiating for it, either with the lender, or maybe you're not going to negotiate it at all, and you'll be violating the loan covenants, which I guess some business owners would say, hey, look, if I breathe the wrong way, I'm probably violating loan documents. So I'm not going to worry about it because I'm still paying. So it's all a matter of balance. But I think it's important that if you do have leasing as part of your business model, you should at least find out, what do this particular loan product say in terms of how I can manage that.
Mm-hmm.
Okay, so we talked about the leasing covenants. Thanks very much. The other kind of operational covenant that can add expense to a business owner is loan financial reporting requirements. So if you're a real property owner, most lenders are going to expect, either monthly, quarterly, and definitely annually, financial statements, tax returns, rent rolls, operating statements.
Mm-hmm.
I'm sure I'm missing something else. And when you're kind of analyzing reporting requirements, the kind of questions that you should be asking the lender as a business owner is, how often do you need it? Does it fit with how I normally produce these?
Mhm.
Okay. So for instance, if they're asking for annual financial statements 10 days after the fiscal year, but you know darn well, my accountant's never going to get to that.
Right.
Count that as an issue and say, hey, I need to have at least 4 months or 6 months.
Mhm.
Or don't make me give you tax returns on April 15th when you know darn well I'm going to be asking for an extension and I'm really not going to be filing them till October, you know? It's, and most lenders are pretty reasonable about this, but they are looking to you as the business owner to tell them what really works for you.
Mhm.
Okay. Because they're not, you know, lenders aren't interested in, I mean, most lenders aren't interested in picking up the phone and say, hey, you're in default.
Right.
Get a
Right.
piece of paper from you. That's not how they're going to have make business, right? They
Right.
want to work with you, but it's kind of on the business owner to tell them, well, this is what my operations are. Can we meet halfway and do this instead? The other important thing about reporting requirements is the business owner should ask if the lender requires GAAP reporting, which is a lot more expensive than income tax method reporting. And then the third piece is, do they require certified financial statements from an accountant? Because that, again, is another expense, right? It's one thing for the manager of the LLC to certify, yeah, these are my true accurate financial statements, versus going to an accountant every month or every quarter saying, hey, can you turn in some certified financial statements for me? It's an
Mhm.
extra expense. So, okay, we covered financial reporting, cash management, leasing covenants. There are also financial covenants that every business owner should be wary of and make sure whether or not that particular loan product they're looking at is going to require them. Financial covenants basically allow a lender to kind of monitor your financial condition.
Mhm.
And if you trip it, they can call a default well before you even missed a payment. That's why they have these financial covenants in place.
Mhm.
Okay.
Right.
So the most common financial covenant is known as a debt service coverage ratio, which in very broad strokes is a formula of the amount of net operating income your property generates divided by debt. And I'm purposely being sneaky when I say that, debt, okay? Because the devil's in the details. When you're calculating debt service coverage ratio, the questions that you eventually will be asking when you're into the weeds of things, not so much at the shopping part, but things to think about is, what are they counting as income and what are they excluding? And then the second part, which is the denominator, is what debt are they looking at? Are they looking at just the loan debt service payments, or are they looking at any and all debt that this borrowing entity might have?
Mhm.
Okay, that makes a difference, because if they're looking at any and all debt that the borrowing entity might have, your denominator of your fraction just got very large, making it very difficult to reach certain debt service coverage numbers. So
Mhm.
that's one thing to look for. The other common kind of financial covenants that are typically imposed on guarantors, so also good to kind of ask ahead of time, is, are they looking for guarantors to maintain any kind of liquidity covenant where they're supposed to demonstrate on an annual basis or quarterly basis that they have liquid assets in X amount of dollars, or that they maintain a tangible net worth of X amount of dollars. And then what's an important covenant when you're a real property owner is, does the lender have an ongoing loan to value covenant, as opposed to just looking at the loan to value covenant at the time of closing? An ongoing loan to value covenant usually is tested annually, if there is one. And
Mhm.
what it allows the lender to do is basically take another appraisal of your property. And if the loan to value number has increased, which means the value of your property has gone down while your loan amounts stay the same, then typically that will either be an immediate event of default, or they will require the business owner to, quote unquote, right size the loan, which means you got to pay down the loan so you can meet the loan to value percentage that they're looking for.
Yeah, and a lot of the 2008, 2010 situation was caused by that, right? Because
Exactly.
the rents fell and the
Mhm.
tenants moved
Mm-hmm.
and
Drop in values, right?
drop in
Actually, and
values.
after 2008, you saw a lot more loans having loan to value covenants, and then they kind of quietly went away. When good times came back. But who knows? We might be looking at a barrage of lending again that puts that back in.
Yeah.
Especially like everybody's so worried right now about what's going to happen in the world of office space leasing, right? And office
Right.
and shopping centers have been on the block as a question mark for a while. So it'll be interesting to see how that plays out. I think the last kind of operational covenant I want to hit on is just gently asking your lender, hey, I'm a business owner. My goal is to make money, and my goal is to really distribute out this money, like any business would do to its members or to its property owners,
Right.
right? I mean, like, I want to be able to take my excess cash flow and make my distributions. This devil may not really get discussed early in the game as we're talking about, but more likely in the loan document negotiation side of things. But what you're really asking here is your loan document say I can't make any distributions at all ever? Because that would really make my life miserable, right? I mean, it would make it really untenable. I need to be able to make distributions at least as long there's no event of default. I mean, that's the bare minimum, right? Or at least to make tax payments, So, just a gentle conversation to have. Usually, the shorter the loan term is, like in a bridge loan context of a year or less or 6 months, it's more difficult to get flexibility on this because the lender really wants to make sure that all the capital stays with the borrower so that they can get repaid back, because the loan term is so short, they're a little anxious that funds may not be there when they need to be. So
Right.
in like a shorter term loan situation, it's more understandable, I think, when the rules about distribution are as severe as that you can't make any distributions at all. Okay, so we touched on quite a bit of things that affect cash flow, bottom line for the borrower in terms of economics. We talked about, we talked about repayment terms, we talked about financial covenants, we talked about the type of collateral and the type of guarantee.
Mm-hmm.
Let's now talk about
exit strategies.
Yeah, like why not, right? Right, like let's say why not be forward thinking, right? And
absolutely.
Let's be forward thinking. I have great plans. I want to retire someday. I want to maybe give this business to my child, or maybe sell it. What do I have to do? I mean, what are the rules if I want to get out of the loan earlier than I thought? Always good to ask these questions, because sometimes it's not so easy to get out and know ahead of time what those rules are. And the reason why it's not so easy is because this is the lender's business. They're expecting you to stay in the game as long as their loan term, because they're expecting a certain return on investment over a period of time.
Mm-hmm.
If you get out too early, you're not letting them realize that return on investment that they anticipated making with you when they signed the loan.
Mm-hmm.
So to discourage early exits, there are some consequences. So what is one of the biggest consequences usually? Usually there's a prepayment penalty, which means if you exit too early, you're going to have to pay some amount of money to these guys.
Mm-hmm.
And the amount depends on formulas. Sometimes it's a sliding scale based on percentage of the loan or percentage of the amount you prepay. What you should be asking if there's a prepayment formula is there any time when I can prepay without having to pay a penalty? And most reasonable lenders will have a grace period towards the last 3 months of the term of the loan, let's say, or the last 6 months, that will allow you to refinance with another lender or even with them without having to pay an extra penalty, because they realize you're not waiting till the day before maturity to shop for a lender.
We hope.
Yeah, we hope, right?
Yeah, that would be a big mistake.
Right. By the way, that's another great best practice tip from Lynn and herself. Do not wait till the day before your loan matures to start shopping for another.
Yeah, just like don't wait until the day before you want to buy the building to look at it. Don't.
Yeah, no,
I mean,
right.
a lot of things.
Good point. So watch out for prepayment penalties. And if you're thinking about exit strategies, not only knowing when you can prepay the loan, because let's say you got a sweet offer from somebody to buy the property,
Mm-hmm.
you got to look at and find out what kind of succession planning can you do within the body of the loan documents themselves. So most loan documents have what are known as due on sale clauses. The most typical due on sale clause is if you sell the property, you trigger the due on sale clause. Ooh, what does that mean? Well, once you trigger the due on sale clause, it means you got to repay the loan. Period, end of story. Otherwise, you're going to be in default.
Mm-hmm.
Okay. So some of the other ways you can trip that due on sale clause is if you transfer membership interests or stock interests that violate what they consider to be permitted. If you file a lien or an easement against your property and you didn't get permission for it. All of these different things are also considered transfers. Or if you enter into a lease that wasn't allowed under the terms of the leasing covenants,
Mm-hmm.
all of these things would be deemed as transfers under most loan documents or many loan documents. And immediately the lender would have the right to say, you trigger the due on sale clause, pay up. Oh, and by the way, because you triggered the due on sale clause before the loan actually matured, you also owe me the prepayment
money.
penalty.
Yeah. Yep.
So it's kind of important to keep keep these questions in your mind when you're thinking about exit strategies. Prepayment
Mm-hmm.
penalty, what kind of membership transfers can I do without triggering a due on sale clause? And, what are the consequences if I do trip it? I think the last thing I probably want to talk to you about, obviously, if you don't comply with loan documents, there are some bad consequences to it. I mean, I'm not going to spend a whole lot of time on it. It's basically, the lender can choose to accelerate. You can pay default interest. They could start foreclosure proceedings. They can activate a lockbox if they've required it so that no money comes to you whatsoever.
Mm.
Any funds in the reserves that they're holding, any escrows that you've been putting money into, lender no longer has to apply those, escrowed funds for that specific purpose. They can now use those monies to pay themselves down, okay? So, and they can enforce guarantees. So just keeping in mind of all this, I mean, people do loans every day. Nobody really intends on tripping and causing a default, but sometimes things happen, sometimes things not in our control. And it's just keep an eye on what these consequences are in the back of your, kind of the back of your
Good advice.
mind. Right.
So how can a business owner prepare for a loan transaction?
So I'd say like the best practices are, start the conversation with the lender early. And if you can at least hit on 5 of these questions, it'll automatically trigger 5 more questions and more dialogue with the lender. And ultimately, before you proceed to loan documents, if you've chosen the lender, you like the product, before you start going down the path of paying a deposit to that lender to start the process, ask for a term sheet. Get a roadmap from that lender. Okay. Don't think, oh, this guy seems nice. He knows what he's doing. No, you will save more headache if you can get some kind of term sheet checklist from this lender, so you know upfront what you're expecting. The term sheet will at least help you get to the most important economic terms. Hopefully the lender will outline the most important covenants in there that they may require. It won't have all the details, but at least the key concepts that are important to you as a business owner, so you know what to expect. If you can ask for like their template checklist, you'll know okay, what are the third-party reports I need to pay for at closing? What are my closing costs, right? And is there stuff that's on this checklist that they're giving me that I already have that I might be able to reuse? Like for most real property owners, one of the big third-party deliverables that can take a lot of time to produce and can be expensive is a survey. Okay, so surveys, if they're, pretty decent, show more than just a napkin cocktail drawing of the building.
Right.
Can be reused if they meet the lender's requirements and a title company is willing to give the coverage the lender is looking for. So as long as, the business owner is willing to sign an affidavit that says, I haven't changed anything, I haven't torn down a building or changed the footprint, 9 times out of 10, you can use that survey again. So, that's a huge saving right there, because surveys can run anywhere from $5,000 to $10,000 on most commercial deals. The other thing that you're gonna want to spend a little bit of time on, it's what I'll call the neglected child in due diligence, is insurance. I can't tell you how many deals get delayed because the business owner and the lender haven't, coordinated and gotten the correct insurance certificates in place.
Okay, that's interesting. I've never heard that one.
Oh yeah, in the commercial context in particular, it happens quite a bit because the more complicated, the more sophisticated and the complicated the lender is, their insurance requirements are pretty detailed. Yeah. And they will not let you close unless every certificate comes back exactly the way they want it.
Right.
Which means a lot of coordination with the business owner's insurance agent. So I guess what I would say to you, a great best practice tip for any commercial property owner is to make sure they have a very good insurance agent who can really help them get to their lender what they need so they can close on time. But I think the last thing I probably want to end here with is every business owner should know that if somebody is telling them that something is not negotiable, don't listen to them. You gotta ask. And if you don't get, so you don't get. But if you don't ask, you're never gonna get. Right. I can't tell you how many people tell me, well, these are really non-negotiable documents. Okay, but if you really want my business, here's some of the things I absolutely have to have. Because otherwise, I'm going to be in default on day one. And I really don't want to be on default on day one.
Right.
So I think that's probably like the best practice tip I could give is don't be afraid of asking. And by all means, ask away, because it's you're their customer, and their job is to educate you on their loan product.
I think a lot of what you talked about, which is kind of like how I always look at things, you need to start with the end in mind. So if you need to do these things, you need to know how do you get to that.
Right.
So, and use someone like Cass to help you negotiate these terms. One of the things I always suggest, and I'll be curious to get your input on this, is that when my clients are buying buildings, that they check with several banks. I don't know, what are your thoughts on that? Because I find that they're all a little different.
Yeah, like I said, no banks are the same. Every bank has a different kind of product. Okay, no mortgage term sheet, 2 mortgage term sheets are going to be the same. But in order to do a fair comparison, you have to be asking the right questions to see what you're really getting.
Yes.
Okay. So one bank you may be really lured in. Oh my God, they're giving me a fixed rate CAS of 1.1% for the next 10 years. Okay, but did you see all this? Are you able to meet these financial covenants that they're also requiring? What about this liquidity test? Or, the other commitment that they have, or you're most likely going to get term sheets when you're shopping, because commitments are a little bit more legal, and most lenders are very loath to produce them, especially regional lenders, because there's a lot of effort that goes into them, and they really can't issue a commitment until they get a little deeper into the underwriting. Okay.
Right.
For term sheets, they should be able to generate. And there could be another term sheet that may have a little bit higher interest, but oh, look, it doesn't have all these reserve requirements, gives a little more flexibility, or maybe the kind of guarantee they're requiring is a little different, right? So you really do have to kind of look at these holistically instead of just looking at one line item and say, oh, I gotta have this. Well, okay, but look at all these other rules. Are you sure you want this? So it's definitely a good idea to shop around. But what I will say is there is an efficiency when you have a good relationship with a good lender who will look out for you. And there's an efficiency when you don't have to negotiate loan documents over and over again with different lenders.
Mm-hmm.
Because then there's kind of like a set pattern in place. So for most of my clients, initially they may have shopped around a little bit, but eventually they'll come down and just, focus on maybe one or two different lenders and just go to them and see what comes back. Because, at the end of the day, you want to trust your lender.
Right. Right.
Who really knows your business.
Right. So like, let's say that you did go out and you found 3 banks and the terms are all over the place.
Mm-hmm.
Is it acceptable to go back to the one that you want to use and say, I got this over here?
Yeah.
And can you meet those?
Absolutely.
Okay.
Yeah. The only caveat I would say is some term sheets may have language in there that says once you've signed the term sheet, there's confidentiality provisions in there, so you can't shop around. So the trick is get the term sheet, see what it says. If it doesn't, if you haven't signed it yet, then you're really not bound, right? And then obviously you'll call the other lender and say, hey, what can you do here? It's kind of like shopping for a car, right? I mean, like, what can you do for me here? Because this guy's coming in, at this and can do this for me. Is this even possible? And they'll know pretty quickly if they can do it or not, because most of these lenders, each of these banks have their own set of rules, their own guidelines, right? So they'll know pretty quickly if they can do it or not.
Right. This was really helpful for me because, I'm not usually involved in all these pieces here. This is really interesting, and I really appreciate your time.
Oh, my pleasure.
So if our listeners or readers would like to get in contact with you, how can they do that?
Well, I'm always available by email, which is my first initial K, Bagchi @honigman.com, or they can reach me at 248-566-8554.
You know what? Why don't you spell that last name for them?
Sure. It's sure. I'll just spell my whole
email address.
Yeah, it's KBAGCHI@HONIGMAN.com.
Great, thanks.
You're welcome.
I appreciate your time. You made this subject really interesting.
Well, I'm glad. I get animated by it because I do it every day.
I know. I think that's when you really love something, it just makes it so much more fun. And I can tell
It does. And I think what we do is you do and what I do is kind of nice because we really help, I like to think we're helping businesses.
Oh,
right?
absolutely. Absolutely.
I mean, I'd like to think that's what we're doing at the end of the day and protecting them. And it's changed. I mean, I'm sure you see the difference every day.
Yeah, it's changing, and
got to keep up with it.
Yeah, it's going to change again with COVID, I think. Who knows?
Yeah.
Who knows? All right. Well, thank you for your time.
Thank you for thinking of me. I really appreciate it. I was glad we were able to connect on LinkedIn.